Even as frontline indices see little change, mid-caps continue to come under selling pressure. Industrials, powers are the big losers while financials eke out some gains.
Ultratech takes a detour from its cemented growth path to invest about 1,800 crore rupees in a cables and wires facility in Gujarat. The move, aimed to fortify its construction business, raises capital allocation concerns. The stock slips.
Stocks of cables and wire makers takes a drubbing on the news of Ultratech's entry, but KEI Industries and RR Kabel both remain sanguine. They see no near-term impact due to the gestation and ramp-up period required, and with the industry on a strong growth path.
The RBI has rolled back its earlier increase in risk weights for NBFCs and micro-lenders in relief to such borrowers. This step is seen as one among many by the central bank to ease norms. Stocks of these lenders rally. Hello and welcome. You're watching us here on Halftime Report. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Patakia. Well, another day where the frontline indices not doing too much. The mid-cap index is the one which is actually taking a bit of a drubbing. The Nifty Bank is outperforming today. The mid-cap index now down by 1.3%. At the lowest point of today's trading session, we have 2,100 stocks which are declining for 470 stocks which are advancing. It's also the February series expiry. And the way the market is poised right now, it looks like a fifth straight month of decline, something that has happened last only in 1996, Hormas.
I don't know what you were doing in 1996, but
I would like to believe I wasn't born, but no, I was born, Hormas.
But yeah, it's history books that you don't want to rewrite in such a fashion, but it is what it is. The index at the lowest point of the day, but still trading in a very narrow range. Still 22,500 is the one that they need to defend as of now. But the broader markets, they are the ones under pressure, specifically led by the cables and wire stocks. We'll get to those in just a bit because they are the ones that are the big underperformers in today's trading session. The small cap index is down 2%, the mid cap index too taking a similar sort of a drubbing. But some of the other names though that are not doing very well in today's trading session is Vijaya Diagnostics is one of them, 9.5% lower. That stock had seen a bit of a spike in Tuesday's trading session before we went into the holiday, and that had seen a 13-14% jump. It's come off almost 10% after that. The other one is Varun Beverages. They had delayed the date of their Ghana acquisition by 1 month, and that is one of those reasons maybe why the stock is seeing the kind of drubbing at the lowest point of the day now, 7.5% lower for Varun Beverages. But the story of the morning, the story of the day has been Ultratech and its foray into the cables and wire space. That stock is down almost 6%, and that has taken the other cables and wire stocks down with it as well. Nigel is joining in with more on this. Nigel, good afternoon.
Well, that's right. That's the big story of the day. Ultratech has announced its foray into the cables and wires business, which has made the cables and wires sector itself very, very nervous. But let's tell you a little bit more about this. They're going to be putting around 1,800 crores over the next 2 years. By December 2026, they expect this, this unit in Gujarat, Bharuch, to in fact be up and running. So that's the commissioning date that they're talking about. The key reason is they're looking at extending their presence in the construction value chain. Now, why has Ultratech basically looked into the cables and wires business? A few factors out here. One is the business itself. The industry tailwind is there because the industry is growing at around 13-14% as we have seen in the past. It's going to be moving from around 80,000 crore industry to around 1 lakh crore industry. Besides that, their raw material sourcing could be better because Hindalco is part of the group entity. So aluminium, copper as well could be made more available. The key reason they highlight though is they're focusing on strengthening its building products division. As of now, Ultratech Building Solutions already has 4,400 outlets. So they want to build onto that. Margin-wise, well, it will be relatively lower because we have seen that players in this space, they function at around 8 to around 12% approximately. So maybe a 10% margin is what you could work with. However, the ROC, currently on the cement business, they get roughly around 15% ROC. But in the cables and wires business, industry, most of those peers, they get around 25%. So margins could be relatively lower, but ROC will be higher. What is the concern then? Why is Ultratech down? The street is fearing the capital allocation wars, which wasn't the case now. They were only focusing on the core cement business. The other factor is why couldn't they do it via Grasim? That's the other option they could have had. How do the numbers stack up? 1,800 crores is not big for a company that generates cash flows of more than 10,000 crores. As a percentage of the annual capex, well, it's less than 10% of that. And the revenue potential could be, given that normal asset turnover is around 4 to around 5 times, it could be roughly around 7 to around 8,000 crores with margins of low teens. Jeffrey says, yes, you could expect a knee-jerk reaction, but they have a buy rating out there. They say weakness should be used as a buying opportunity. For the time being, the street doesn't like capital allocation that they have done right now. They would have preferred it to be in their core cement business, which explains why the stock is down by close to around 5.5%. Back to you.
Right, Nigel, thanks a lot for that. So that's one side of the story. Ultratech deciding to allocate 1,800 crores over the next couple of years towards cables and wires business. The street does not like the capital allocation out here, and that's why the stock is down 6%. But on the other hand, what this has done is set a flutter of selling, or maybe set the cat among pigeons in the cables and wires industry itself. So KEI industry is down 19%. You have Finolex down 6%. Look at some others, RR Kabel, all of them down in double digits. Havells itself in the morning was down by closer to 9%, though has recovered currently with a cut of just about 5.5–6% itself. Big disruption happening in this space. Has all the cables and wires segment investors worried? Are the companies as worried, and what the brokerages are making of it? Upasana joins in with the details of that one. Upasana.
Well, certainly, Mangalam, cable and wire segment is under pressure today as the street fears increasing competitive pressure with the entry of Ultratech Cement. Now, Ultratech Cement plans to enter wire and cable segment with an investment of 1,800 crore as highlighted earlier, as the company aims to meet the demand of growing cables and wires industry growth across the various sectors. Now, cable and wire industry has witnessed a revenue CAGR of nearly about 13% from FY19 to FY24. What the street fears is this entrance of Ultratech may intensify competition for the existing large players. Now, looking at the FY24 market share of the top players, Polycab stands at 26%, followed by KEI, which stands at 12%, followed by Havells, which stands around 11%. Now, brokerages like HSBC is of the view that this entrance is likely to have a material impact on the growth and margin trajectory beyond FY27 of these players. It has lowered the target price somewhere between 7 to 23% of all the major cable and wire key players. Coming to Havells first, the brokerage has given a buy rating with the target price cut nearly about 7% to 1,730 per share. Polycab, it has given a buy rating with a target price cut of nearly 20%, lowering the target price to 6,250. KI Industries, the brokerage has given a hold rating and the target price is cut as high as 23% to 3,450. And lastly, RR Kabel, it has given a buy rating and the target price of 1,260. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing players such as Finolex Cables and Havells, and Polycab continues to remain the key preferred pick for the brokerage. Now, coming to Morgan Stanley, it says that it is surprised with the move of Ultratech entering into the cables and wires segment, but it says it is not concerned about the industry play going forward with this entrance of Ultratech. So all in all, we are seeing all the stocks under pressure on the back of this competitive pressure.
Indeed, the street caught by surprise as well. And interestingly, they compare the FY25 multiples to their 5-year averages. Both Polycab and KEI are still trading above those multiples even after this correction. Where in fact, we spoke to Anil Gupta, the chairman and managing director at KEI Industries, to understand the impact of this foray. Listen into what he had to say.
This and the market space is big enough to give space to another player. Number one. Number two, Ultratech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them.
This is very big industry, and like almost 85–90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market and it is very like on negative side market is conserving. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me. So first, when we see from like margin point of view, first you need to see that it will take at least like 2 to 3 years to come into production, and again getting a sizable size of production and getting established in market. It may be another journey of 2 to 3 years. So it will altogether like 4 to 5 years minimum to take sizable size, even in this overall industry, which will be like around 1.5 lakhs by FY 28 or 29.
Right, it's an interesting state of affairs right now when you look at the entire cables and wire space, Hormaz. Why is that? Because there were times when the markets are in a good bull run, any diversification from the core was something that was appreciated by the street. When we saw the entry into paint, so we saw entry into other things, the street was appreciating that because that meant newer markets. But now it means margin dilution, and as a result of which the street is a little worried about that. What's interesting is that Ultratech sees opportunity, but Ultratech analysts see capital allocation concerns. The incumbent players, they don't see any fear, but the shareholders of these incumbents, are worried about what those guys could do. So it's a very interesting space to be in right now, and most definitely we'll keep tracking this as we've been tracking the disruption that we saw in the paint space as well. So that was our Insight Edge special segment on Halftime Report in the cables and wires segment as Ultratech made its foray. With that, we'll step into a short break. But as we do that, let's give you some good news. So all our viewers, here's India's business news leader, which is now just a click away on the CNBC-TV18 new app. Whether you're using iOS, whether you're using Android, you will get instant access to breaking news, in-depth analysis, and all the financial world updates. All of them coming to you at your fingertips itself. All you got to do is download the app from either the Apple Store or the Google Play Store. What you can do is scan the QR code. Hormas is just doing that right now, and you get a link to download the app on your screen. Once you get the app, you get everything on your fingertips. Stay with us.
Welcome back on to Corporate Conversations. Now the management of EPAC Durables is joining in. Ajay Singhania, the Managing Director and CEO of the company, is joining in to talk about the road ahead for the company. Mr. Singhania, good afternoon. Thank you so much for joining in. Well, we sitting here in Mumbai are definitely feeling the heat even before the month of March has set in. Has that reflected in your demand trend so far for the air conditioners? What is the trend that you are picking up on ground, and do you see this intensifying further as you go into the peak summer months?
Yeah, so good afternoon, and we never saw the heat wave actually subsiding during the whole of last 12 months. So yes, the momentum continues, and it started picking up already with a very sound order book, and further the demand is kept on increasing. So I mean, we're heading on for an extremely good summer season again, it seems.
All right, so what does that mean in terms of numbers? If you could give us a sense, what did you do last summer? How much higher have the orders been for this summer? And are these orders for ODM products or OEM products? Are they margin accretive for a business like yours?
So the entire year, if you look at the calendar year, definitely the industry grew at something like 40% plus, and at EPAC we grew at around 75% in terms of the overall revenue. So the momentum continues. The industry seems to be looking at, again, a repeat like 20-25% growth for this calendar year as well. And at EPAC, we are definitely geared up to beat the total growth. So, I mean, again, we are looking at 40% plus kind of growth for the calendar year or for the financial year 26, 27, 25, 26 as well. In terms of order book, yes, extremely sound order book. And the last financial year, I mean, 24-25, definitely we are looking at 55% plus kind of a growth, and repeating a similar performance, 40% plus growth for the next year is definitely on the cards.
All right. And what proportion, if I remember correctly, about 2/3 came in from room air conditioners, right? You have been moving into other consumer durables as well, washing machine being one of them. So I just wanted to understand, heat wave does well for your air conditioner business. What about the other parts of your business?
Yeah. So significant change compared to the previous year is, although AC is growing at like 30-40% for us as well, but overall the revenue from ACs from 80% has come down to almost 66% in the last quarter. On the year end, we're looking at the dependence on AC to come to a level of, let's say, 70% around. So overall dependence on AC has reduced from 80% to 70%. Our other segments like the component business and the newly launched large appliances like coolers has already picked up, and washing machine is something we are looking to ramp up from Q1 of the next financial year. So all in all, definitely the other levers are firing for us as well. I mean, the component business and the export business, the small appliances and the large appliances all.
So does the AC business in the scheme of things remain at 70%, Mr. Singhania, or as your other businesses grow, that will come down to a more 60-65% sort of a level? That's part one. And part two is, how is inventory management looking like currently? Because there is some issues of demand-supply mismatch over the last few quarters.
So first of all, AC definitely we continue to have a robust growth, but at the same time, the diversification drive we have taken, we believe that the growth in the other sectors will be much more rapidly. So overall, we want to reduce our, balance our portfolio in a way that AC comes down to, let's say, around 60% in the next 2 to 3 years. So that's the overall direction we are following, despite growing at 30-40% in AC as well. So that's on one. On the the inventory rationalization, a lot of localization of components have already happened. So that has helped us to reduce our overall inventories. But at the same time, because of the supply chain issues from China, the BIS impact and all that, there is certain mismatch in the industry, but we are well balanced with sufficient inventories of both copper and compressor going forward. So, I mean, we are aligned with our order book and we have sufficient inventory in place.
All right. What about coolers? AC is one of the heat beaters. Coolers are the other. Coolers are a lot more mass market. You have production capacity of 60-70,000 per month. If you could give us a sense of what your order book out there is, what the realizations per cooler are, and how margin accretive is that business? Because what we're trying to get at is, while AC is growing fast, you have other, businesses which are also ramping up. Capacity utilization will pick up. What are the target margins that one should look at for a business like yours?
So cooler for us is one interesting category we entered in last January. So January 24 is when we entered manufacturing coolers. Last 12 months, we have ramped up cooler production. So starting with like a number of 10,000 per month, today we are almost doing like 45-50,000 coolers every month. So that's the kind of capacity we have currently in place. The interesting thing about cooler is that it's as compared to AC, which has a 6-month manufacturing cycle, cooler almost has a 10-month manufacturing cycle. So that definitely helps us utilize our production capacities and our asset turn, improve our asset turn. Another thing is that on margin side, yes, the margins are almost similar to that of an AC, but at the same time, because the capacity utilization overall improves throughout the year, it helps us improve our asset turn, improve our balance our cost. So that's definitely one good thing we find about the cooler industry, and it's growing. So for next year onwards, again, we have lots of other OEM getting associated, more products coming to us. So we are looking at ramping up our capacities further.
All right, your guidance for this year is up for you.
No additional investment done. So, I mean, the fungibility of our manufacturing capacity is definitely helping us get into.
That's incredible. So, your FY25 guidance is up for the viewers on the screen. 2150 crores in terms of revenue, and 7.25 to 7.5% is the margin guidance that you had given us at the end of the third quarter. Now, as things stand for the next year, you believe that you can grow in around that 40% mark when it comes to revenue. What about margins?
Margins will try to maintain at similar levels, EBITDA levels of 7.5 plus minus.
Despite a 40% growth, you do not foresee any improvement in margins, Mr. Singhania? Are you still looking to maintain it, or is this a conservative estimate?
So let's see, improvement is something we're definitely striving for, but when it comes to guidance, I want to be slightly conservative, not give a very... but definitely we're looking to improve further, yeah, surely.
Right, and final question before we let you go. Air fryers will obviously be a very small part of your overall revenue, but how big do you expect this category to be for you, and what's the scalability here?
So air fryer is a very interesting category. It's a localization drive. So it's something which is getting shifted from import to local. And definitely we are looking to ramp up capacities from 50,000 per month to almost 100,000 per month in the next 3 to 4 months. So manufacturing 1 million air fryers in next calendar year, that is 26, is definitely on the cards. And from revenue side, I mean, it's like 200 plus crores, at least in next year, is the kind of revenue guidance we can have on the air fryer alone.
How much does an air fryer sell for typically from a business like yours?
So an ASP of 2,000 2,000 is something for us, and then the markets, it's like 3,500 to 4,000 is the market MOP.
Okay, so that's how you come to the 200 crore mark, which is 2,000 rupees for a million pieces. Okay, thank you so much for joining in and giving us all those data points for analysts to ponder over for the next couple of years. We will most definitely keep track of the temperatures and your sales in conjunction with those temperatures as well. With that, take a short break, come back, talk about the markets. Aditya Agarwala of Invest for Edu joins in with some trading strategies. Welcome back. You're watching us here on Halftime Report. Even as the Nifty is down about 20 odd points, it's interesting because it is also the February series expiry. And if you look at the FNO setup on the day of February series expiry itself, you'll see that, the Nifty has actually seen a big correction over the last 5 trading months itself, or 5 trading series. So you look at October, where the big fall started, 2,000 points shaved off the Nifty. Thereafter, the subsequent months, you had another 1,000 points shaved off. And now February so far, we've lost almost 720 points. This compares with the start of the series itself. And this will make it the 5th series loss for the market and the first time that happens since 1996. So that's how bad, history has been created from a bull standpoint. Bears are happy to be waking up for 5 series after 28 years. What's interesting, however, Hormaz, let's bring out the iron condor once again, which is the 25,550 level. So if you look at the the action that option writers are playing out today, they are selling the 25,550 call and the 25,550 put. Together, you pocket a premium of close to around 30 rupees. So you have the 25,550 put at close to around 22 rupees, the 550 call at around 10 rupees. You sell that, you get about 30 rupees. How do you protect yourself? You buy a 22,600 call and you buy a 22,500 put. 22,600 call available for 4 rupees. 22,500 put is available for about 9 rupees. So in a sense, you are pocketing a premium of 30 rupees. And to protect yourself from a wild swing on either side, you are buying options worth really 14 rupees. Net, you take home 16 rupees. That's the iron condor strategy, which is playing out on expiry day today. What does that mean for, the range of the Nifty? For 30 rupees, 35 rupees that you're pocketing, you are expecting the Nifty to stay between the 30, 35 rupee range of 22,550 on either side. So that's 22,515 at the lower end, and at the upper end, it's 22,585. Were the markets to move on either side, you've already bought those options that will protect you from that hedge. So that's the iron condor strategy that is playing out by the option writers on expiry day. But in terms of individual stocks, just keep an eye out on a bunch of these names come up for you on the screen. There's Abbott, Atul, Bata, Canfin Homes, GNFC, India Mart. It sounds like Shankar Mahadevan's breathless, but there are 16 stocks exiting FNO trading come tomorrow itself. So last day for all these stocks to trade. So maybe in the last hour, we'll see some wild swings on the names that are flashing for you on the screen, largely because positions will be unwound out here.
I'm not very sure of iron, but bulls definitely need to have nerves of steel to be optimistic in a market like this. Hopefully, March will bring in some bit of cheer for the bulls after 5 straight negative months. Take a short break, but will that optimism happen in March? Aditya Agarwala of Invest for Edu will join us on the other side to answer just that and share some trading strategies as well. Stay tuned.
Hello. How are you?
Good.
I was doing CNBC for like 30 years. CNBC is only 25. So I
ये IPO हो क्यों नहीं रहा है, right? That was a comment that you made saying everybody is getting cleared but not us.
I think until 28th November it was not clear that IPO हो रहा है या नहीं हो रहा है.
Maybe the regulators and the government don't want fintech. fintech as a sector, I still see as a sunrise sector. India needs billions of dollars in investment in fintech.
Who breaks the silence medium? He speaks only for, in the business and professional setting. You would not imagine he's an introvert. We are also trying to scale up in UPI with innovative products instead of basic, UPI.
So this diversification is going to be crucial for you, isn't it?
It's a person who's probably living in tier 3, 4 town or city. They don't have the means to go to a different place and earn higher returns or get loans, etc. So for them, we solve the problem of access. Followed with the at heart, she's deeply emotional and she cries a lot.
Really? I would never have thought that.
In our house, we have a competition between her and our kid, who can cry more on very silly issues.
You're actually a softie.
I'm actually a softie.
Welcome back. Still at 22,520 is the Nifty, and Aditya Agarwala, the head of research for investments at Invest for Edu, is joining in on the show right now for a quick chart check. Aditya, good afternoon. Thank you for joining in. Well, do you expect the expiry above 22,500A? If so, where do we go from there? And if not, where do we go from there? And couple that up with your trading ideas as well.
Hi, afternoon, or good afternoon. Thanks for having the show. Afternoon, Mangalam as well. Oh, that's a very tricky question to answer, actually, whether markets will hold on to 22,500 or not. From the looks of it, looks like we're going to expire somewhere around 22,500 for sure. I don't see a sharp sell-off, even if we have to break 22,500 just for a brief period of time, maybe 50, 60 point here and there. I think 22,500 should hold because clearly the back is against the wall right now for the bulls, and every pullback is getting sold off. So it's little extreme pessimism that I see on the charts as well. Oversold levels, we're trading at a couple of positive divergences on multiple time frame charts as well. So everything is pointing towards a short covering rally from here on almost. Maybe give or take, like I mentioned, 50, 60 points from here on. You can't rule that out. But if you can bear that in your trading, I think it's a good time to look at some of long trades, given the fact that risk to reward is in favor of going long at current levels. And look at how Bank Nifty is outperforming today. So Bank Nifty is the catalyst. I think if Nifty has to go up from here, so 49,000 of the Bank Nifties, I'm very closely. If 49,000 is taken out decisively and trades above that, towards the fag end of the trading session, I think Nifty will also show some kind of strength. And maybe I think 22,700 or 23,000 is what I'm looking on the Nifty for the next expiry, I would say rather next couple of weeks. So I'm not too pessimistic at the current point of time. But yes, prices have yet to confirm, and 22,500 I think should hold in today's trading session for sure.
What about...
having said that, yeah.
I just wanted to know, what about individual stocks?
Yeah, I've got one buy and one sell, Mangalam. So the buy recommendation is from the banking space. IndusInd Bank looks interesting to me. I think it's formed a base from here on. It can inch higher. So for a target of 1160, I would take a long trade here with a stop loss at 1030 on the downside. A short on Ipca Laboratories. Pharma is clearly the weak back in today's trading session. I think this weakness is likely to continue. So Ipca Laboratories can be sold for a target of 1270 on the downside, keeping a stop loss at 1420 on the upside.
All right, Aditya, thank you so much for sparing time, joining us today with your views on the index and on specific stocks as well. Take a short break, continue our coverage on the markets this expiry day. Stay tuned.
Welcome back. Let's get an exclusive chat now. My colleague Shilpa Ranipeta caught up with the CEO of Trent P. Venkatesalu to discuss about their business momentum and growth outlook. She began by asking about the consumer demand sentiment. Listen in.
I do think it does vary by market. And also, I've always maintained in various interactions, Shilpa, that these things are never linear. If we look at the trend business itself over the last 10-15 years, have we had a completely smooth run over quarters, years, months? Not at all. And if you look at it over a period of time, if you look at it over the medium term, you do get a very consistent play out on what happens to the market. And which player succeeds, which brand succeeds, etc. is a different question. And I'm obviously very biased. But I do not think India as a market, India as a consumer space is going to be any less interesting in the next 5 or 10 years.
Right, fair enough. And what is the way forward or the plans currently, if you could tell us, for Zudio? Because in your results, you also announced a store optimization plan. So will the fast-paced expansion that we've been seeing for Zudio, will that slow down? How are you looking at the store expansion and the business expansion for Zudio?
My chairman spoke about it in the shareholders meeting. We put out stuff every quarter. I don't think so we've changed any of the commentary. I think the best way to comment about it is look at every time we put out our commentary in the quarterly results. I do think we're quite enthusiastic about where we are going as a business, Shilpa. And the market, I do think, over the medium to long term will be also very interesting. There are enough challenges and wrinkles to fix at any given point in time. And we'll continue to grapple with them.
But something that you can give us on Zudio, what the business is looking like for you going forward. How do you look at closing this fiscal with Zudio and the kind of plans that you have for the next?
I'm not going to obviously answer anything specific, but I do think I can say that we are quite enthused by both our brands in the fashion space, and we are also enthused by Star in the food space, definitely so. And we'll continue to build on the existing platforms, and we do think over the medium to long term we'll have a very interesting play to be had.
So will Zudio continue to be the growth driver for you, or will it be Westside, Zudio and Starquick? Like, what do you see as the growth driver for Trend?
We do think all these three are growth engines, and Zudio is definitely one of them. Westside is also very important as a growth driver in the portfolio. And I've said this in the past, Shilpa, that we think we are more of a platform. We would like it to be a platform. We don't want to be a Zudio business or a Westside business or a Star business, but a platform which originates, incubates and scales brands, which has some common threads.
And Star Bazaar also, do you have aggressive expansion plans for that? Because currently you're just there in 3 places. More cities, more states, is that something that you're looking at for Star Bazaar?
We have said this, and we're quite excited about where Star is going. We do think we have a model which is quite differentiated. We'll build with the same playbook that we have in the fashion side of the business. And as far as the expansion program is concerned, watch out.
I just wanted to quickly check with you also on the Zudio front. Zudio Beauty is also something that you have been expanding. What are the plans there? And also, can you give us a sense of how much non-apparel segments are also doing for Zudio? How much is it bringing in?
Shilpa, I've got this question many times over, and hence we've started reporting it on a quarterly basis, at least giving commentary on it. So the emerging categories, which include innerwear, beauty and footwear, now accounts for about 20% of the lifestyle propositions that we have.
Right. But are you looking at more standalone Zudio Beauty stores also? How big is the beauty portfolio for you?
Beauty is material out of this 20% beauty. Is it material? Yes. And is it something which is exciting for us? Yes. But are we applying the same playbook? Very much so. We have completely own branded, completely non-distributed, and definitely not advertising led, and so on and so forth. So are we approaching beauty the same way as we would approach any of our other lifestyle propositions? Very much so. And are we excited for it as a category? Yes. How much we turn around and do standalone stores, how much we do inside Westside, inside Zudio, etc. is a matter of play out, Shilpa. Right. So we'll see.
But it's definitely under consideration. That's what I'm trying to understand.
We already have some.
Yeah, I know. So more of that.
Let's figure it out.
Okay. But the response has been good initially?
It's been encouraging, in generally very encouraging. And also the proposition is not completely different from what we have in Zudio or Westside for that matter. Right. They are akin propositions in the sense they are relevant for the respective brands.
Right. And how do you see the competitive intensity playing out currently? Because a lot of other players in the value fashion space have also come up, across every large apparel player. So how do you see the competitive intensity playing out?
India was always competitive, Shilpa. It was never a non-competitive market. And to that extent, if you have really no choice as a business playing in this space, being relevant to the customer. Right. The whole trick is constantly change and see how you can be more relevant. And if you're relevant, you have a good chance of being differentiated. And if you're differentiated, hopefully you have a good way of being relevant to the customer. So it's kind of a circular reference in that sense. But I do think we need to change, constantly improve, and be relevant to the customer. That's the way forward.
The management of trend in a rare interaction there with CNBC TV18 on the road ahead. By the way, Mangalam was mentioning the FNO exclusions in today's trading session. A couple of names already under pressure. Naveen Fluorine, one of those exclusions, is down 4.5%. Dr. Lal too, at the lowest point of the day now, trading with losses of over 3% in today's trading session. Many more FNO exclusions. We'll talk about them as the day goes by. We'll take a short break. On the other side, Manisha Gupta joins in with Ajay Kedia, who is the director at Kedia Commodities. Stay tuned. We'll be right back.
Welcome back, and joining us on the show now is Ajay Kedia. He's director at Kedia Commodities. Ajay, hi, thank you for joining in. The Q question really is about gold, because we've seen the prices come off its highs after almost $29.60 an ounce. We are trading below $2,900. First of all, would you call this a profit booking, or this is an opportunity to start buying into the space?
Very good afternoon, Manjay. Definitely, it could be a profit booking, because already we have seen prices was under correction till 25.40 in the month of November. We have seen a low, and since then it's almost $400 rally we have seen. Nothing has been changed in last couple of months. We still have Donald Trump as our US president, and we know the man is known for its tweet. So I can't predict on Donald Trump that what will be the next tweet. But as of now, definitely we have seen a multiple rejection around 29.50, 60 zone. So unless and until we don't have any strong reason, I think $3,000 is going to be slightly little tough for gold to breach as of now. So I think a technical profit booking could be possible. Maybe this fall could be towards 28.56 as an immediate support.
Ajay, the other thing that the markets really seem to be reading on is in sense of the sovereign gold bonds, where the expectation is that you still have a hard task ahead of the government, 61 more tranches to be redeemed, and that would continue to go on until 2032. What's your sense on the gold prices if you look at such a big period there, and what really should the investors be looking forward to?
Yeah, I think gold bond was a very attractive bet for investor to look, because since 2014 we have seen when this tension has started. Earlier to this, we Indians generally consume gold. We don't buy or we don't invest. We generally consume. But looking to the bond, there was a new opportunity that we can invest in gold. We can take a return as other asset class like equity and other asset class work out. So it was a very attractive bet for all investors. But I think it might be a nightmare for government, because looking to the sharp rise post-COVID, what we have seen in gold prices is slightly a nightmare. But I think immediately inflow in ETF has been increased, and people are now moving from equity to commodity. So there are other options are available, like secondary market they can purchase, but definitely a good investment opportunity has been, I think it will be a nightmare for government, and investor will definitely move for some other, because the craze for gold is going to be there in 2025 also.
What also is your sense for silver prices now? Because we did see multi-month highs onto this one as well, but silver, like various other base metal prices, also has not been able to hold on to its gains. So when you look at silver and also copper, Ajay, what would be the near-term targets or near-term strategies for a couple of these now?
Coming first on silver, right now gold-silver ratio is very close to 90, which clearly shows the silver is still underperforming as compared to gold. The reason behind is the, we can say, industrial demand, because post-COVID and war, Russia-Ukraine concern has still not picked up as an industrial demand. No doubt, Futures have been quite good with the green and clean energy demand, which will help silver to go further to the level of $38-40 this year. And but as of now, nothing has been putting up from China side. So I think some consolidation would be there between $30 to 34 in international, in domestic market. It can take slight more time to breach 1 lakh psychological level. As of now, 90,000 to 1 lakh could be the level we can see for next couple of months. But overall, I think as compared to gold, silver would be attractive bet as we move to the year end. Coming on the copper, still since last year, we have seen a very good talk is going for EV demand or industrial demand should put up on a positive side. But I think a rally has already been seen in last couple of months from the level of 810 to almost 870 on MCX in international, and LME prices are slightly consolidating in the range of 9300 to 96, let's say. So I think some sort of profit booking could be possible, but overall, I think if we talk about copper, I'm expecting more room to be there. But before that, a drop towards 850, 855 would be a good level to re-enter, targeting at least 900 level mark in next couple of months.
All right, Ajay, thank you so much for sparing time and sharing with us some key levels on all of these commodities and precious metals. Manisha, thank you for joining in as well. With that, it's a wrap on this edition of Halftime Report Business Lunch for the next 30 minutes.